Welcome to the Options Income Blueprint Weekly Report. This is Michael Schulman on June 21st, 2022. Uh, Reminder, you may be watching this after it is over, but we're to trade today at 11 o'clock Eastern Daylight. I'm going to go over the trade results from last week, a little bit of a review of the market, because it's really hard to do a detailed review of a market that cannot make up its mind. And I really want to take a look at how we trade in something very relevant given our current positions, and that is a look at selling calls. Last week, a couple of new positions, one new position in Teladoc. We were being conservative given the Fed announcement, and we rolled our Citigroup put rather than accept shares because the math was in our favor. And the last week to goal, for obvious reasons, because it was a light trading week, and we spent a little bit of money to do some things. We didn't hit our annualized goal. That's a rarity. I think that's the first negative since I've been doing these updates. So given everything that's been going on, I'm pretty comfortable with that. I don't see this happening again in the future. So again, a little breakdown. We didn't have a tremendous amount of activity last week. I think the activity that you're going to see just come forth starts today, tomorrow, the selling of calls, perhaps the rolling of a couple of puts later in the week. I think we'll make up for the quiet that we saw last week. Now, that quiet was due to what was going on in the market. The Fed raised rates with pretty neutral language. There was not a lot of surprise. The market popped, sold off, then popped again. It's hard to say what is short covering, what is concerns about more raises in interest rates, what is the concern about recession. And it's split. The two issues facing investors are the impact of inflation on corporate profits and consumer demand and so forth and so on. And recession, investors are looking longer term. And they're on the sidelines in part because they're scratching their head, and in part because they're going, I don't think I want to buy the dip right now. And these are professional investors. The two issues facing traders are volatility. We're up 100 points on the S&P one day, we're down 100 points on the S&P the next day, which is actually very good for selling options if you catch it the right way. I'm assuming, maybe too much, but I'm assuming that we're going to see a reduction in volatility, perhaps starting around earnings season, which is 2-3 weeks from now. And a slow-moving bear, it could be really, really profitable for us. I mean, exceptionally profitable. And this all leads up to, in my opinion, a great market for selling covered calls. Now, let's step back for a second. We sell options. Okay, we trade positions, meaning multiple trades on the same stock week after week, month after month, not transactions. If you're looking at this a purely transactional way, if it's your first couple of weeks in, I hope you're listening. When I put on a trade, I'm not assuming that we're going to stay in it, except for the 4 core stocks, but we may very well stay in it for quite a while. Based on membership concerns and based on survey results, I know, especially those of you relatively new to the service, prefer selling puts, but we do own shares and sell calls based on market conditions such as we're experiencing now. The overall focus is on capital preservation and generating weekly cash from that capital. And losses occur when we close a position, not an individual trade. And to get a little bit more in the weeds on that, and have an example coming up in Teladoc, is a position, as I said, could be one transaction or many. And the reason that we get high rates of return is because we're willing to sell puts with strike prices close to the share price, because we are willing to accept shares if they're put to us. And you have to be willing to manage positions and not say, I can't take it. I'm out on Friday. I'll see what I do next week. There has to be a consistency in your approach that's aligned with your goals, actually. And the bottom line is you can't separate high cash rates of return unless you view trades as part of a position. And here's an example. We're in a Teladoc position. It's a net debit. Rather than hold it through a Fed meeting, which really could hit volatile stocks. And then we sold the $25 put, reducing our net debit on the position considerably. So it's a paper loss. You're looking at red on your broker screen, but it's not a loss yet. We're not closing the position. I'm anticipating, not promising, excuse me, but anticipating we'll be out with a profit in a couple of weeks. And this is not just the best way to manage positions to goals, but to go through and bear through and succeed through and win through this kind of market. Now, we do close positions when we can pocket profits early when we have a small loss, and that small loss in the chart is heading the wrong direction. Okay, let's go for now. Now, we'll take a loss almost independent of the movements of the charts if the story behind the company or the stock changes. This happened with Chewy.com, for example, when management really didn't have any answers for the problems they had with operating margins and so forth and so on. But we simply put, we don't close because the stock in the market is moving against us in a given, like a week or a few days or what have you. Now, rolling puts versus accepting shares and selling calls has been a question for a decade in this service, and it's based on potential rates of return and return on capital in the form of cash that you get with the next trade. And accepting shares and selling off gets us back to break even or profitability just faster. That's particularly complicated. And last week we accepted shares on most of our positions because the math was more favorable. Let's take a look at what we did. Now, as you know, when I put something in my bullpen, the group of stocks that I plan to trade, either this service or the Masters program, there's some thresholds. There's got to be an identifiable trend that I've identified in the real world. From that, the best companies taking advantage of that trend. Within that, the best stocks based on metrics, valuations. Not necessarily simple valuations, but valuations appropriate to that industry, that sector. Then you look at the charts. Is it something that you can predictably trade in some way? Predictable being quite a term right now. And then the option change, they liquid, and then the premiums. And the rule of thumb that is the ultimate bar is if I sell the next strike up or down and that option expires worthless, will I do 0.5% or 26% a year? What does that mean? So if Pfizer, the top line here, is at 46.53, the next strike would be 47 if you're selling a call. These are all, because I'm talking about calls, this is calls. Citigroup is actually a put in the service, but I wanted to illustrate what this means. Now, so you can see the logic of accepting shares. I didn't get any email complaints that I normally get, so maybe people have already come around to this because I know some of you prefer puts, harshly prefer puts, don't want to talk about calls. You look at the cash rates of return, and Sunrun is high because they only have monthlies. And the total rate of return is if you're called out. Those are gigantic numbers for all but one or 4 day. This was last Friday, so it'd be calendar a week, but it would be 4 trading days. Those are gigantic rates of return and gigantic annualized rates of return. So does that mean we should always sell the next strike? No. You could sell considerably out of the money when you're getting those rates of return. And what you sell, first, what are your goals? Second, what are the charts telling you? Are there events around the horizon such as earnings? What are the premiums, and therefore bring that back to your goals. So the bottom line is it's not an abstraction. In my own portfolio, and I've written about this, I do have stocks that when they're in there for a certain reason, mainly cash generation, like our core stocks, I do next strike every week. And we had a service, the PIPC service, that did that, which we discontinued a while ago. And one of the reasons is that we got a lot of people signing up and then they would quit because they didn't accept the premise of taking a paper loss 1 week and making it up 2 weeks later. It was just too difficult for many people, and I hope you can accept the basis here of what I'm talking about. So what does this mean for going forward? For Q3 trading is we have an expanded universe of stocks because of volatility, but we're also, with our calls and even with our puts, of course, we're going to have more distant strike prices, and the target rates of return, which have always been 0.5 to 0.8% for a week, I'm raising to 0.6 to 1% given volatility. And it also means we may roll a little bit more, we may accept shares a little bit more frequently, but there's a lot of volatility in the market, and I want to put it in the form of premium in our pocket. We're going to maintain a current bias towards selling calls in the existing position. The new positions will be puts. And please, let me repeat, volatility will not determine the stocks we trade, but it will determine the tactics we use to keep the cash rolling in. This is Michael Schulman. Thanks for listening.